3,739 million as compared to rupees 6,506 million in the first half of FY20. Consolidated EBITDA margin percentage was at 15.6%. The net profit was rupees 1,422 million at 5.9%. This includes the Maharashtra State Mega Project Incentive of rupees 637.32 million. During the first half of 2020-21, a standalone total net income was rupees 16,530 million as compared to rupees 26,649 million in the first half of FY20. Standalone EBITDA was rupees 2,424 million as compared to rupees 4,539 million in the first half of FY20, with an EBITDA margin percentage of 14.7%. Standalone net profit was at rupees 1,025 million at 6.2%. This includes the Maharashtra State Mega Project Incentive of rupees 637.32 million. The detailed financials are available with the stock exchanges and on the Endurance website. I would like to share certain key points for the first half of this financial year. In the first half of FY21, 69% of our consolidated total income, including other income, came from our Indian operations, and balance 31% came from our European operations. In quarter 2 of FY21, 73% of our consolidated net income was from Indian operations and 27% were from our European operations. During quarter 2, our factories in India and Europe did not face any mandated lockdowns since August 2020. We continue to do our best to ensure a safe workplace for our people. In India, in the first half of FY21, rupees 3,618 million of new business was won from OEMs, which did not include the Bajaj business. This business was from HMSI, TVS, Hero MotoCorp, Hyundai, Suzuki and Yamaha. This business will reach peak sales in financial year 22. I would like to mention that we have rupees 12,344 million worth of requests for quotes from OEMs. For our new customer TVS, as mentioned earlier, we have been awarded rupees 1,963 million of 2 and 3 wheeler brakes and suspension business. Further, rupees 540 million of brakes business and rupees 276 million of suspension business is being discussed. As our combined braking system business is growing with addition of TVS and HMSI new brakes business, and also in order to de-risk operations in our Aurangabad brake assembly plant, we are setting up a capacity of 600,000 per annum CBS brakes at our Pantnagar Uttarakhand plant, which will start operations from January 2021. We are also setting up a cylinder head low pressure die casting plant at Pantnagar Uttarakhand for 720,000 numbers per annum, and operations will start in March 2021. In October 2020, in our oldest die casting plant at Waluj, Aurangabad, our company announced a voluntary separation scheme for 86 confirmed workmen with a one-time payout of rupees 112 million. This will lead to an average wage cost saving of rupees 48.7 million per annum and additional savings in canteen, workplace and insurance related to these 86 workmen. In 2021, we will also start supplies of brake assemblies, suspensions and aluminium castings, including the battery housing castings for electric scooters and three-wheelers. I would again like to mention that Endurance is focusing on a more value-add and profitable product mix in its future business, which includes 200cc plus motorcycle brakes and clutch assemblies with the help of our acquisition of Adler and Grimeca in Italy, paper-based clutch assemblies replacing the cork-based clutch assemblies for motorcycles, continuous variable transmissions or the automatic clutch for scooters, anti-lock brake systems or the ABS for 150cc plus motorcycles, inverted front forks and adjustable rear monoshock absorbers for both domestic and export OEMs. This is with the help of our collaboration partners KTM. and fully finished machine castings as compared to semi-finished castings for 2, 3 and 4 wheelers. For our European operations in the first 6 months, we've acquired 10.83 million euro of new business from Audi, Maserati and Fiat Chrysler. This business will start from 2021 onwards. Also, the consolidation of our foundry activities from 2 plants to 1 plant in Italy, which will lead to a saving of 600,000 euro per annum, has been completed. Both the Adler and Grimeca acquisitions, which included all the know-how, patents, brand and trademarks, have helped our Indian operations in getting new business for 200cc plus motorcycle clutch assemblies and brakes from Indian OEMs, which will start in the financial year 22. I would like to especially point out that Endurance is actively involved in looking out for technology-oriented and new product organic and inorganic growth opportunities. I would also like to mention that in India, Endurance is entering 2 backward integration product areas, which are import substitutes also. First is the aluminium forging axle clamps required for our growing business of inverted front forks. Endurance has entered into a technical collaboration with FGM Italy, and production will start at our Aurangabad plant from April 2021. The second product is wire-braided hoses required for ABS brakes, which will start operations in quarter 3 of this financial year, which is in this quarter. Both these 2 projects, are in the first half of FY21, our aftermarket business in India was almost at 5.3%. The aftermarket sales were rupees 883 million in the first half of FY21 as compared to rupees 1339 million in the first half of FY20. The aftermarket sales are growing very fast both in India and the overseas markets, and we hope to reach the average monthly 2019-20 sales value in this quarter of this financial year. I also wanted to update you that our new Vallam plant near Chennai for supplying machined aluminium castings to Hyundai, Kia and Royal Enfield will start operations from next month. We are also happy to inform you that we have won rupees 320 million of new business with Hyundai, which will start in October 2021 and will be supplied from this new Vallam plant. The net sales with Hyundai and Kia together are expected to reach rupees 3,070 million in the year 2022. We are also at an advanced stage of testing clearance for our ABS brake assemblies. As far as the CSR activities at Endurance is concerned, we are focused on education, health and sanitation, livelihood generation and environment in the first 6 months of FY21. We have created a sustainable change in 25 village areas and partnered with stakeholders in 5 more. We've also started the renovation process for 2 Zilla Parishad schools, constructed 23 toilets, supported 70 farmers while training them on agricultural best practices. We continued our Nala deepening and sill lifting activities and planted 4,000 trees per acre in the dense forest of 3.75 acres across Kachner, Andaner and Pimpri near Aurangabad. We also started online classes for our vocational training students in English and soft skills. We have started running a 81-bed COVID-19 care center in Aurangabad for asymptomatic patients and also given 5,400 food kits to the needy in Pantnagar, Chennai and Aurangabad. These food packets can sustain a family of 4 people for a month. At Endurance, it will be a continuous endeavor to grow through organic and inorganic growth with a focus on technology upgradation, quality improvement, cost and environmental health and safety. We will do our best to fulfill all our stakeholder expectations by following our 5 values of customer centricity, integrity, transparency, teamwork and innovation. With these opening remarks, I would like to invite questions from all of you. Thank you very much.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ronak Sarda from Systematic. Please go ahead.
Hi Anurag, congrats on a great set of numbers. Another first question on the ABS supplies. I mean, you highlighted that it is under customer approval now. How confident are we, to begin supplies in the current financial year?
See, let me tell you, we have cleared the important tests, very important tests related to about 11 types of test tracks. I mean, that's the test which took us 2 years actually. So the good news is we have cleared that. Now there will be an endurance test which will take place. And of course, we are hoping, we have been already allotted also an ABS brake for a vehicle. I cannot mention more details here. And we hope to start, if not in Q4, but in the first quarter of FY22. But the main thing is we have cleared these very important 11 tests based on the benchmark, So that's the good news. But I didn't want to speak too much. As you've asked me the question, I'm telling you that.
Right.
But we are on the right track for the ABS.
Okay. And does this even help us, to expand our client base now? I mean, are these tests common for, when we approach this for ABS product with other clients? How would that work?
All the clients, once we have got clearance from one client and we start, everybody else will follow.
Okay, sure. And the second question was on the profitability. I mean, pretty strong EBITDA performance. How do we see, given the operating leverage kicking in, how do we see that sustaining? And the VRS impact in India and Europe, both, where we have closed foundry plant as well. Are these accounted in the other expenses or they have been treated as exceptional?
You are talking about the consolidation in Italy?
Yeah, consolidation. So we had VRS
from this month, the gain of 600,000 euro per annum. I don't think that's been counted. That Massimo Venuti can further clear it. I think this was completed last month from what I know, but I think he can clarify. As far as India is concerned, what is your question?
So,
as far as India is concerned?
Yeah, the VRS impact when you, what you have highlighted, is
the
that...
VRS impact will only come from this month onwards because it was completed on 31st October. So that impact which I mentioned will only come from, which is about, I think, 47 million rupees, apart from other costs which I mentioned, which are linked to these workmen like canteen, transport, other costs are there, insurance. So there'll be an extra saving on that. So that will only start from this month onwards. So that's not included in the Q2 or the first half numbers.
So my question was this 112 million payout to these employees.
That will happen in this quarter. In Q3.
It will happen in Q3. Okay, sure. And on the Europe side, there's some, margins have been slightly weaker than our usual, trend. Any specific, cost item which has led to that impact?
Okay, I will request Mr. Venuti to answer that.
Okay. No, we closed the second quarter with 17.4% of EBITDA compared to 20% of the previous year. For sure, there was an impact in terms of mix of product because, as you know, in the last quarter we have had in the European market an important increase of registration in electrical vehicles, and for sure, as Endurance, we have had an impact with the reduction of the existing internal combustion engine technology. But if you analyze the profit and loss, you can see that the different mix is also affected by an important reduction of software. If you see, there is 37.9% of cost of material compared to 31% of the previous year due to the fact that in order to save cash in this moment, we reduce in important way the stock. In the third quarter, I believe that this situation will change because now apparently the volume are going up, and so we will be able to maintain or to increase again our stock. And for sure, the impact in the EBITDA will be positive.
Sure. Great. That's really helpful. And another question for Massimo. I mean, we are seeing a second wave of COVID cases, coming up in Europe. Any impact do you foresee on the European operations in Italy or Germany?
No, in this moment, frankly speaking, we have several problems because there are thousands and thousands of people involved in this activity. Also in endurance, we have had some cases, but the situation is absolutely under control. We are working 18 shifts per week, and we are respecting all the requests of our customers. So in this moment, I don't see problem. The only question is that it's not so clear which other restriction the government will take place in the next week, because the situation not only in Italy but in France and Spain in this moment we are suffering a lot with our final plant of our OEM, because sometimes they shut down in order to do sanification, and this means reduction of productivity and reduction of turnover.
Sure. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Aditya Jawar from Investec Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. A follow-up question on Europe. So we see there has been a sharp contraction in gross margin, and in the past our EBITDA margin was quite volatile, considering sometimes we used to outsource the manufacturing. But if you see the reduction in gross margin on a sequential basis, almost by about 8 percentage points. Any specific reason? And in considering we have done this consolidation of plant, and we have arrived at a equation of balance of outsourced manufacturing and in-house, what could be the sustainable EBITDA margin in the next couple of years?
Okay, as I told you before, in the second quarter we have had a reduction of 3% of EBITDA compared to the previous year, but there is a different mix compared to 2019. First of all, because we have had an important increase of electrical components, and as you can imagine, these technologies, these parts, these products started 12 months ago, 6 months ago, and we have had an important reduction of diesel and gasoline version. Okay, but the impact in our EBITDA, if you analyze the single line of the profit and loss, the employee cost had a reduction compared to the previous year, and is the same for the other expenses. The important increase was only in the cost of material consumed, because if you analyze the balance sheet of the company, we have had a reduction of 6 million euro stock. What does it mean? During the month of August, in order to optimize our production, we closed 1 week, and in this week, we closed 2 weeks. In these 2 weeks, we reduced the stock, and we maintain this till the end of September in order to save the cash. Only this. Regarding the sustainability of the profitability, if we will be able to come back at the same level of turnover of the previous year, I don't believe we will have a problem. For sure, there will be an impact due to the different mix compared to the previous year for the electrical component and the internal combustion engine component. But I don't want to say that the electrical component has a profitability lower compared to the past. It's only a question of start of production. It's normal that the level of efficiency in a product that you produce till 5 years ago is different compared product efficiency of a product that started 6 months ago.
Absolutely, that's very helpful, Massimo. But again, sorry to asking this question again. So this mix change that you mentioned, that electric vehicle proportion, could have likely electric component proportion would likely increase, and diesel had come down. So that factor could be there, could continue for the next few quarters, and that essentially means that there could be a pressure on gross margin over the next few quarters until and unless the volume ramp up for the new products?
Frankly speaking, I believe yes, and I explain to you why. From my point of view, there will be a different impact in our profit and loss. I explain to you why. In the past, as you know, when we invested for transmission and engine component for internal combustion engine business, we invested a lot of money for a few period of time. What does it mean? The continuous changes in the normative. Our product had the benefit for 5 years maximum, 3 years, 4 years. Now with the electric platform, we are seeing a period of life of this product of 10 and more years, 10, 12 years. And that means that the impact in terms of the investment will be less compared to the past. Because still 5 years ago, 2 years ago, we have to invest every 2-3 years in different model of engine and transmission. Now the period of life will be higher, and this is positive from one point of view, because for sure we will invest less and we will have an impact in terms of depreciation that will be less compared to the past. But also the profitability will be different, because you have to consider that when you change continuous the range of products, it means that you have to invest in tooling, and the customer pay part of this tooling. And so from my point of view, in terms of net results, there will be no impact. Probably we will have a benefit due to the fact that we will optimize the saturation and also the utilization of our machine. In terms of product margin, probably in terms of EBITDA, probably there will be an impact due to the fact that the components that we are producing for the electrical vehicles are different compared to the past. They have a different period of life. Only this.
Okay, that's quite helpful. Moving on to India business, considering what we are hearing that the inventory level of two-wheelers is relatively higher on the ground as compared to passenger cars, what is the outlook? Anurang, your customers would have shared with you in terms of production schedule. Are you seeing the momentum continuing in the next few months?
Yeah. See. In fact, if I see in this month, though we are 22 days, we have to work for 24 days, and you won't believe the per day requirement with some of the OEMs is higher than even October, where we had the highest growth of 34.5% ever, highest ever sales in India. So what people are saying, of course, next month will be down. The end of the calendar year is always down. But how much time down, I do not know. It will be down. But I believe that two-wheeler sales, what I'm hearing, at least from my major OEMs, are quite good in the quarter 4 this year. Quite good means lower than this festive demand of September, October, but I would say much higher than I think 1920 is what is the expectation which we have at Endurance after hearing. But only time will tell that, But having said this, see, as far as Endurance is concerned, I would like to make it clear. Of course, industry growth is a big factor in growth. I do agree. But for us, we are taking a lot of new business. We are not only growing with Bajaj. I mentioned about low pressure die casting cylinder heads and brakes plant, which is coming in quarter 4 this year. But say if you take Honda for example. Honda last year we did 6,080 million. This year our focus is to achieve the same in 9 months. Next year, I want to go to 9,000 million rupees. Why? Because I've got an additional brakes clearance. I've got the first inverted front fork business. My scooter suspension, which actually started only in January 20, will reach almost 3,500 million next year. So Honda is just going great. As I said, we have grown 18.6% over quarter 2 last year. If I talk about Hero MotoCorp, we did 2,160 million last year. This year, we'll cross 2,600 million only in 9 months. And next year, because we have got new orders for brakes, inverted front forks, and the Halol plant which we started will reach from 2,400 to 4,700 sets of front fork shockers a day. Next year, we are expecting this figure to go to 3,500 million with Hero. If I talk about say Yamaha we did 2,070 million. I'm expecting 3,500 million next year because we have got brakes business, new alloy wheels coming up, and we make money in these projects. Then we come to fourth OEM, which is TVS. We had no sales with them last year, though we started Q3 with some suspension business. So it's practically zero. But next year, this business will be minimum 1,650 million because of the brakes and front fork shocker business we have got. So point is, there is a lot of new business coming in for endurance. It's not a question of sales growth. That, of course, is important. I mean, if external factors will affect the two-wheeler automotive growth, that's a different issue. But we are taking a lot of new business. And I've not even mentioned about the aluminium new casting, machine castings for the four-wheelers, which is also additional business coming up. So our focus is to get new business. That is number one. Secondly, what we are doing is we are upgrading our products. Like I mentioned in my earlier opening remarks, we are because of the acquisitions of Grimeca and Adler, for the first time we'll get into the 200cc plus in a major way for our clutches and brakes business from FY22 onwards. That's a big thing. I mean, this is business we are not doing today. Okay. Plus, I've already told you about slight increase in alloy wheel business for both Yamaha and Bajaj, plus the Pannaka new business. So we are taking a lot of these all incremental businesses, So for me, as far as I am concerned, I've always said since IPO days, I have no control on the external environment. I'm focusing on new business and cost controls. I mean, that's my job here. And that's what we as a team and endurance are trying to do.
Absolutely. My final question, if you see that performance on gross margin front has been pretty impressive, in this quarter also there was almost a 220 basis expansion on the standalone gross margin. So if you can help us understand to what extent it is driven by, higher share of proprietary business or, and what could be the benefit from raw material and, essentially, that will give a good understanding on sustainability of the gross margin.
Yeah, see, I will not give you specifics, but that is totally related to material cost percentage decrease, something in variable cost, something in fixed cost. Fixed cost saving is almost 2.5 crores per month, which is not bad and sustainable. We are going to make full efforts to sustain this. Number two, like you rightly mentioned, the product mix is improving. It's improving because of upgradation. And you're right. Upgradation is mainly happening due to proprietary business and machine casting business. As you know, we started Hyundai and Kia. It's fully machined. The business is going to reach 3,070 million in FY22. This business started and we are making some good money in there. So it is definitely a product mix as well as cost. It's a combination of both. And I've always said in the last 4 years, our focus is on these things. And fortunately, lockdown, that was not good for us. First quarter was a washout, where we did only 26% of last year's sales. But this has been a huge opportunity for us to introspect, to focus, and go into attention to detail of how to control costs. So this actually has been an opportunity, and that's why you are seeing these margins also.
Okay. Yeah, that's it from my side. Thanks a lot and all the best.
Thank you. Thank you very much.
Thank you. The next question is from the line of Vimal Gohil from Union AMC. Please go ahead.
The opportunity. Sir, you had given some growth rate on HMSI, Yamaha, Suzuki. If you could just help me with what has been the growth rate with Royal Enfield this quarter. Most of the other questions have been answered. Thank you.
Royal Enfield, there has been actually a degrowth. I would say it is a small it's a very small degrowth. Let me just tell you. Just a minute. Royal Enfield. Yeah, we have degrown slightly. We have with Royal Enfield. See, I can see the share of business of Royal Enfield decreasing overall. See, the share of business has basically decreased for Bajaj Auto in spite of their great sales. And for Royal Enfield, I really made up in Honda, Suzuki, Yamaha, Fiat Chrysler overseas. I don't. Can Mr. Ray or Raj tell me the figure of degrowth of Royal Enfield? I don't seem to find it in my paper.
Yeah. Royal Enfield sales quarter to quarter, quarter two to quarter two has been lower by 12 crores.
12 crores, but what would be the percentage?
Last year, quarter 2 was 7.7%. This year is 6.8%. And the decrease over last year is about roughly 12%.
Yes. So does that answer your
What was the
question?
decrease in Bajaj Auto?
Sorry?
What was the decrease in Bajaj Auto this quarter?
Yes. So decrease in Bajaj Auto, overall has been, I'll just tell you, it has gone down by 3% and minus 6.5% as a value. But that's also because of 71% of sales in July, But as a share of business, this 3% SOB loss of Bajaj has been made up by Honda and Yamaha and Suzuki and Tata Motors. We have done quite well, 38.5% growth.
Right. And sir, the decline in Bajaj Auto would largely be because of because of the we are not present in some of the models or
No. In fact, if you ask me, we have grown with Bajaj, but because the others have grown more, Bajaj has become less.
Can I add another perspective? Bajaj production numbers went down by 12% quarter to quarter.
Okay, got it. And sir, just you said that you're putting up a TVS facility in Uttarakhand.
Yes.
I missed out the number of units that would be
600,000 per annum, and it'll start from January 2021.
Right. And sir, what is the total capacity that we have there?
Right now, we are not doing brakes. We are only doing some finishing operation of like oil bleeding and all. But now we will start to make and assemble brakes in Pantnagar. It was being done in our Aurangabad plants. But like I mentioned, we got new orders from Honda and TVS. So because of that, we don't want to risk everything in one plant. So this will be a new order. I mean, we are taking this business from others.
Fantastic. Thank you so much, sir, and all the very best.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Congrats on a good set of numbers in testing times. Sir, first clarification on incentives which you have received in India business. We indicated 537 million incentives for second quarter. Does this include 279 million for the prior period?
Yeah, it does.
Okay.
Just to explain this in a little more detail, you may recall that our incentives, till we received this additional 99 crores, we had got about 367 crores of eligibility for mega project incentives. So the additional inclusion due to inclusion of financial year 18-19 was another 99 crores, so which made it 466 crores. So from this 99, for prior years of FY19 and FY20, we booked 27.9 crores, and the quarter 2 FY21 booking is another 25.8 crores. So that makes it a total of 53.7 crores booking in quarter 2.
Right. And we'll have one more installment coming in 3Q, right? Given the increase which has happened.
Yeah. Now the number will be calibrated, Dinesh. We will be booking now based on 467 crores. That will be the
new benchmark.
Divided
okay.
And then taken appropriately in the books of accounts.
Okay. And this 467 crore would be over 5 years now, or over 7 years.
So it's 7 years. It's 7 years.
Over 7 years. Okay.
But if your question is whether 467 will follow the original 7 years, it will follow the original 7 years. It is not an additional 7 years.
Okay. Got it. So effectively another 5 years left. Okay. Got it. Secondly, with respect to India business, we have seen increase in depreciation. Any reason why depreciation has gone up in India business?
Yeah, previous year there's been a lot of capex. I mean, last year we've seen capex. So that's the main reason why depreciation has gone up on capitalization.
So this would be more sustained run right now. Okay. Coming to the European operations, there we have seen quite a sharp increase in staff cost. Is there any one-off in that, or does it pertain anything to 1Q or this 950 million per quarter is the new run rate there?
I will request Mr. Deluti to answer that.
Yes, we closed the second quarter 2020 with 11 million euro of employee cost compared 11.8 million euro of the previous year. There was a reduction due to the shutdown of the plant in Grugliasco because we have had the benefit in 13 indirect people. But you have to consider that in this moment, even if we are producing more or less with the level of saturation of 60%, with a reduction of turnover of 10% compared to the previous year, in this moment we are not eligible for the short time working. What does it mean? This is the difference compared to the first quarter of 2020. We are not receiving benefits from the government. They don't pay part of this cost due to the fact that all the companies that they have had a reduction in less than 20% compared to the previous year and are not eligible for this support. And this is the difference compared to the previous quarter. But if you analyze this quarter compared to the previous quarter, there was a reduction of 800,000 euros, more or less.
Right. So the current quarter staff cost run rate is more a normal run rate to follow about 950 million. Is that the right way to look at it?
No, honestly speaking, I don't understand the figure because the total employee cost is less compared to the previous year. So I don't know.
Okay. Yeah, maybe you are looking in euro terms. I'm looking in INR terms. So
there's another thing to be considered that euro has appreciated by 10% quarter on quarter. Q2 last year versus Q2 this year.
That's a fair point. So that's understandable. And the last question pertains to Mr. Jain.
Yes.
We have talked about potential revenue coming from CVT. That's one product which you have been working upon. Any update on that? I mean, where are we in terms of the development cycle and how far are we away from commercialization of that?
Yeah, see, on the CVT, we are definitely working with 2 OEMs. And the question is, this COVID-19 has pushed back because of their priorities on the final testing. And our focus is to keep continuing to try and see that these testings are cleared with both the OEMs, So the thing is, it has slowed down, but the focus is fully there on the CVT business.
Okay, so would it be fair to say this is more to this looks more likely towards FY23 kind of opportunity and not FY22?
See, it could be partly FY22 and partly FY23. Our focus will be something in FY22, but it can go to some business can go to FY23 also.
Right. And lastly, with respect to the passenger vehicle as a segment, how much does it contribute to the India business now? And given the ramp up which we are seeing with Hyundai, Kia, and Tata Motors over the next 3 years, how do you see the share changing?
See, the way I like to put it is right now it's about 6.5%, I think, of the India business, because overseas is all passenger cars and commercial vehicles.
Sure.
But the point is, this percentage depends on how well I do with other two-wheeler business, with the other OEMs, where we are growing very rapidly with new business, with new product mixes, upgradations. So it will depend. The percentage depends on that. But like I said, our focus is mainly on castings, machine castings, the Hyundai, Tata, as well as Kia. These 3 are the major customers which are emerging. Like I mentioned, 3,070 million we should reach in FY22. I mean, that run rate should be by last quarter of FY22. And this machine, and that's where the new Vallam plant is being set up. And so we'll focus on getting more and more machine casting. But as we speak, we are also getting into new clients, new customers. I can't name them. Maybe on the next call I will. We are working with another 3 and 1 existing OEM to get more machine casting business. So that is our strength,
Right.
So we will, as an amount, to answer your question, the amount will go up but as a percentage, I don't know. It depends upon how the other two-wheeler grows.
Right. That's a fair point. I mean, obviously, two-wheeler side also we are looking at a very strong growth, which is understandable. And how much would be Kia and Hyundai contributing? Roughly 5% now?
No. See, it was, we will reach 3,000. Right now, it's not much. Just let me see if I can get that figure. Right now, it's a small figure. It is, I'll just tell you. Right now, it's only 1.2% of our India business.
Oh, okay.
So it's very small. So it's a long way to go.
So then 5%, I mean, of the 6.5% PVs, Hyundai and Kia are just 1.2. So balance is what, Tata Motors?
Yeah. The balance in a big way is Tata.
Oh, okay.
Tata is a very old customer and we are growing very fast and they have done very well. That's why I said we grew 38.5% with them. And plus we have exports. Are you aware we are exporting to GetRack?
Okay, that's part of it.
So we have export of machine car seats to GetRack for the plants in UK and Europe, in France. So that is also contributing in the four-wheeler business.
Right.
So it's Hyundai, Kia, Tata and exports.
Got it.
Sorry, that figure is 2%, not 1.2. I was wrong. No, it's 2%. Hyundai, Kia is 2%. I just took Hyundai, there's also Kia. So it's 2%.
Got it. Great, sir. Thanks and all the best. I'll come back in queue.
Okay, thank you.
Thank you. We'll move on to the next question. That is on the line of Niket Shah from Motilal Oswal Asset Management. Please go ahead.
Yes, thanks for the opportunity. Just two questions from my side. Given the cost initiative that you mentioned, what is the standalone margin that one should build in for the next 2 years? And also, if you can just highlight your strategy on how do you plan to de-risk from your two-wheeler business and expand more into four-wheeler business, which might include some M&A thought process also. So if you can just give us some sense over the medium to longer term.
See, the thing is, like I've always said, we will keep focusing on increasing the margins. Even without mega project, I said we have done 14.7% based on our cost focus on fixed, variable and material costs. So definitely see, we will keep focusing as we get more and more economies of scale, the fixed costs go down. So I would say that one should target a similar, if you ask me, I would like to have a 15% margin at least for India, which I think we will try and do if it can be sustained, But this is without the mega project incentive, obviously, And so going forward, and see, it's very difficult for me to say because see, one is the product mix upgradation happening, product mix also changing. And at the same time, we have to look at the new business which I get is that price is lower than the competition I have. So I have to keep working harder and harder to try and sustain these margins. So as you are seeing, we are improving. So I can only tell you we'll keep improving. But if you want a figure, I just can't pinpoint a figure. I would like to be at 15. Right now I'm at 14.7. Without a mega project incentive. So let's see how it goes. The second question is regarding the two-wheeler. See, why we are stuck to two-wheeler? Because if you see the last 10 years, the CAGR of a two-wheeler.
Sorry to interrupt. Hello?
Yeah.
Hello?
Sir, we are not able to hear you. Ladies and gentlemen, the lines of the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently holding. We now have the line for the management reconnected. Over to you, sir.
Yes. So I was talking about, the question was the focus on four-wheelers versus two-wheelers. Now see, if you see our past history for the last 33 years, I mean since we started in 85, so about 35 years, we are focused on two and three-wheelers, on process and product technology, and become a leader. We are the top two in all our four product segments. Suspension and casting, we are number one in the country in terms of, I would say, growth, technology. The question is, you should do business from a position of strength. Now, our strength is in two and three-wheelers largely, in the proprietary products. Casting, we are doing two-wheelers, three-wheelers, and four-wheelers, and with the help of our technology we get from overseas, which is largely only four-wheelers, we are growing our business well in the casting domain. Okay. Now, the thing is that if you even see the last 10 years, I'm sure the data is there with you, but two-wheelers have grown at 6.4% in the last 10 years, CAGR, compared to passenger vehicles, which has been 3%. And the point is, I mean, one can talk about strategy of going into electric vehicles, for example. And I said, we are going to do our brakes and suspension, and we have got a lot of castings starting in FY22. As far as electric vehicles are concerned. Let's see where that goes, in terms of volumes. Today, volumes are very low. So the question is, as a strategy, we don't see two-wheelers going anywhere. I mean, they are here to stay for a long time in a country like India, And so, for us in endurance, two-wheeler will be definitely a major focus, and so will the passenger cars be for castings. But having said this, we are looking at organic and inorganic opportunities in the passenger vehicle space, which we are actively looking at, talking about, which I cannot state right now till these projects are cleared, which we can talk, whenever I'm ready. So it's not that we have lost focus, but if you talk about these four product areas, even in one of the calls previously I mentioned, the opportunity in suspension, brakes and clutches is not much in the passenger car. There are too many players and volumes are very less. What volumes are we talking about? 4 million in a year, And so there are not many opportunities in our product areas. Maybe in new product areas, opportunity can be there in passenger cars. But in castings, machine casting, we see a huge opportunity which we are taking with Hyundai, Kia, exports. So what I'm only trying to say is that we will focus on what we can do well. And as well as look at organic, inorganic opportunities, which make sense in terms of potential growth, which are also EV specific, and which have where I can make a good margin, good profit margin. So I think the thinking is coming more from there, for our team at Endurance.
Perfect, sir. Thank you so much and best of luck.
Yeah, thank you.
Thank you. The next question is from the line of Shanti Patel from Shanti Patel Investment Advisors. Please go ahead.
Good afternoon, sir.
Yes,
my
yes.
Question is, my question is, what is our share of different segments in the industry, and what is the return on capital employed and return on equity as on today? And what do you think about next 2 to 3 years?
See, if you just go through our financials, even since IPO, we have generally been always near 20% in ROE and above 20% in ROC. Now, I think I mentioned the figures. I'll just take it out again. The ROC and ROE figures. I'll just tell you. Yes. The consolidated ROC was at 19.2% and ROE at 18.5%. I'm talking about 30th September 2020 now. And if I take the stand alone, my ROC was 24.4% and ROE was 18.8%. And positive cash flow in both consolidated and India.
Right. And our market share in respect of different products, if possible.
See, market share, you're talking from what angle? You're talking about all India?
Yeah, in India only, not outside India.
No. So are you asking me that how much? What is our in the sense? Our share of total say front fork business now in India. Are you talking like that?
Yeah.
Okay. So for example, in scooters and motorcycle, if I take quarter 2, I'm around 40%, more than 40% of the front fork market. Shock absorber maybe around 36%. Transmission we are at 14%, which is your clutch assemblies, and brakes we are at 27%. Just to give you an idea, as per quarter 2 of all the motorcycle scooters which are sold in India.
What is your thinking about increasing the return on equity and return on capital employed in next 2 to 3 years?
See, we are always focusing above 20. See, the question, it depends on what kind of opportunity is and the external market conditions. But if you see, we have been very stable on both these factors. We are very, very conscious. As I have said, we are very financially focused company and technology focused company.
Yes.
I've always said that, and we believe in higher than industry growth and profitable growth only. So I would say both these should be above 20%. That is always our target.
Correct. No, that is very good. Thank you very much. Thank you, sir.
Thank you.
Thank you. We'll move on to the next question. That's from the line of Arvind Sharma from Citi. Please go ahead.
Yeah, hello. Good morning, sir, and thanks for taking my question. Sir, 2 questions, one on the India business and one on the European business.
There is a siren which has gone off. We just pause for about 10-15 seconds.
Sure.
I'm not able to hear your question, Arvind.
Sure, sir.
There's a siren gone off in our factory. Okay, yeah, please carry on.
Great, thank you, sir. So in the India business, I know you've alluded to the demand trend, but if you could just elaborate a bit more on how you see demand going ahead. My reason is because we keep on hearing about news snippets saying that there's a big inventory build-up at the dealer end, especially in two-wheelers. So one, on the two-wheelers, and secondly on the three-wheelers part as well, given the social distancing norms, three-wheeler sales have declined. So both of these aspects, what is your view? That's my India business, sir, and I'll ask my question on European business later.
As far as the India business is concerned, this month, in spite of, because I saw the figures of FADA, which is the Dealers Association, they talked about a 27% down in two-wheeler, retail versus what they bought from OEMs, okay? Now, I don't know who are these OEMs and these figures. I only know as a company that my sales per day this month is higher than even October, which is the highest ever in endurance. The feeling the outlook I'm getting from major, I would say top 3 major OEMs, is that next month also will be much better than the previous years. Last month, and they are hoping for, because I told them that what happens to all these capacities we built up, and they are very clear. Please do not let your guard down, because the volumes will be good. They won't be like your festive demand, obviously, like September and October or this month, but definitely it will be higher than 1920, which I mentioned earlier. So that is a sense I get from OEMs. Now only time will tell what happens,
Yes, sir. And three-wheelers part, sir?
Sorry? Yeah, as far as three-wheelers are concerned, you are aware that it's badly down. Maybe it is a question of this COVID-19. People don't want to share three-wheeler taxis, and passenger cars are a lot high sales. So I don't think three-wheelers improving till the COVID-19, till a vaccine is found. That's my view. Till that positive sentiment comes back of a vaccine coming in and people feel they're safe, I don't see three-wheeler sales going up. But having said that, the export markets are really opened up for Bajaj, I know, and the exports are doing quite well. So I think this question is for Bajaj Auto, what they feel about three-wheelers, But I feel personally in India, till there's a vaccine, I don't see three-wheelers improving.
Sure. Thank you, sir. On the one question on the European operations as well. Is it possible to share the European revenue EBITDA and PAT in euro terms like you shared last quarter?
Yes, I'll request Massimo.
Sorry, can you repeat? What do you want to know?
No, he wants in euro terms the EBITDA and the PAT, I think.
The revenue EBITDA PAT, sir.
EBITDA and PAT in euro terms, in fact, I have it.
The Q2, the EBITDA was 9.8 million of euro on top of 56.3 million of euro of turnover, 17.4%. Net result 3.8 million of euro, 6.8% of the total income, compared to 6.7% of the previous year.
Right. And Massimo, what was it the previous year, Q2FY20, if you could share? Sorry for this inconvenience.
In Q2 19, we have had the turnover of 61.6, so this year a reduction of 8.6%. The EBITDA was 12.4 million of euro with 20.3% of EBITDA, and the net result was 4.2 million with 6.7% percentage.
All right. Thank you so much for sharing this. Thank you, sir. Thanks a lot.
Thank you. Thank you, Arvind.
Thank you. We'll move on to the next question. That is on the line of Ashutosh Tiwari from Equirus Capital. Please go ahead.
Yeah, hi, sir. You mentioned about this Yamaha order and the sales next year. What's the number? What was the number for last year and how much you're looking in next year?
See, last year with Yamaha, we had done 2,070 million. And we are expecting next year to be 2,500 million because we have won a brakes business which will start in first quarter of FY22. Plus alloy wheel is also going up. But this is an approximate figure. It could be slightly higher, slightly lower, I don't know. But Yamaha figures 2,500 million next year is our estimate.
Okay. And any plans on increasing alloy wheel capacity or still you're not decided?
No, see, at present we have increased the capacity in our existing plant,
okay,
which is to, I think, about 135,000 sets, which is about 270,000 wheels per month. Beyond that, unless I have a good commercial, there is a lot of demand for alloy wheels. But till I know I can make money, I will not take the orders.
Okay. And on the HMSI side, you mentioned last year sales of 6,080 million.
Yes.
You're looking at 9,000 million in the current year or next year?
No, it will be next year. This year I'm targeting to do the same in 9 months. Because first quarter HMSI was practically closed in this year.
So actually, then you are running at the same almost 300 crores run rate right now in per quarter basis?
So basically, no, it's not the same run rate because you have to divide around 5,750, 6,000 I said, divided by 9, So it would be about what? It would be about 8. It will be about, say if I do, it will be about 7,500 to 8,000 million this year. The run rate per annum, if you take it.
Okay.
Next year, I'm saying 9,000.
Okay. And this is mainly because of the new brakes order and...
See, one is the suspension business is really going up. We are doing already one type of brake. We have got another brake clearance. The inverted front fork clearance we have got.
Yeah.
So, clutch volumes have gone up, And I am assuming a volume of 6 million for, HMSI, which is not much higher than 1920, to be honest,
Okay.
So I'm assuming 6 million. So it is with that assumption. That much they should do. Because even scooters are coming back now, scooters. You can see from September, scooters are coming back, which were down for 2 years.
Okay. So HMSI, TVS will be two major drivers and, HMSI and Yamaha. TVS, how much you did last year and how much you planned?
Last year was practically zero. It was zero actually.
Yeah, you got the first order. Yeah, okay.
Yeah, we just started small way with suspension, but practically zero. So it will be all new next year. Of course, this year we should do around, say about 500 million.
Okay.
About 400 to 500. We're just starting off, with brakes and suspension. But next year we should do at least 1650 is what is our guess. And this is assuming that the volumes are the same. I mean, if volumes increase, then this figure goes up because we work on SOB, share of business.
Okay. And last on the European operations, you mentioned that because of this higher mix of EVs, the margins have come down. So, is this a new normal margin, or maybe from the second half of next year we can assume that probably margin will be higher than what we delivered in Q2?
Now I will request Mr. Venuti to answer, but everything also depends on volumes. So the volumes have to come back, like he mentioned. I heard him say, but let him answer that. But I would say in a situation like this, when you are down, to make 17.4% is not easy. It's damn difficult. The consolidation of our foundry will help us to get another 600,000 euro per annum. Okay, that will start maybe from this month. Okay, that's a good sign. But then there are other challenges, with this COVID-19, outbreak in Europe. But I would like Massimo to answer that.
In this moment, I can speak about 2020. In 2021, we are waiting the figures for budget from our customer, and in this moment the sentiment is positive considering the last 6 months. But I want to see which will be the level of production, because in the European market in this moment, even if you are seeing a reduction of 8.6% in terms of registration, you have to consider that each country, Germany, France, Spain, Italy, we are having a reduction in terms of production of more or less 5-6%. And so it means that in this moment, they are reducing only the stock. For sure, in this moment, there is pressure in terms of pricing. For sure, in this moment, there is a lot of problem in terms of volume. But you have to consider that the major problem in this moment is that in order to respect the normative for the COVID-19, in this moment, we have more or less a productivity of 85% in terms of efficiency compared to the previous year. This is our major problem. And so I'm pretty sure that if the volume come back at the normality, and so it means that we can saturate our plant with 70-75%, that is a leverage, a minimum leverage for a business has machining and foundry, we can come back in the same profitability. But it's also correct from my side to tell you that for sure this revolution in the electrical vehicle compared to internal combustion engine will change our mix of product in our profit and loss. And so it means that we will invest less compared to the past, and probably we will have a contribution margin that is less compared to the past. But in terms of net result, in terms of payback of the investment, probably the situation will be better compared to the past. We always told you that our business is absolutely capital intensive. Probably with this revolution, there will be a less impact in terms of investment compared to the past. This is the only effect from my side.
Okay, the two things. One is that with this EV higher volumes, the capex requirement will come down, so your asset turn can improve. And secondly, you said that let's say if the volumes go back to say FY20 level, then the margin will be maybe slightly lower than the earlier.
I explained to you which is the problem. The problem is only one. In the month of October, for the first time in the history of the European market, we have had more or less 25% of the total vehicles registered electric. 25%. Oh. You can imagine what does it mean. Okay. But it's not a problem that endurance lose market, because 95% of the electrical vehicles are produced directly by the OEM. You have to consider this. BMW, Volkswagen, Tesla, they produce, Renault, they produce inside this vehicle. In fact, what they are doing, they are moving the existing production capacity for internal combustion engines to external supplier, and they are investing and they are installing the new line for the electrical vehicle. This is the problem for the next 2-3 years, because this is the history of our business. For the first period of time, when you develop a new technology, you produce this part inside. Okay? When you arrive after 2-3 years, in order to make synergy, you start to give in outsourcing this activity. And so we have to suffer for a period of time of 2-3 years. This is the normality of the history of the automotive market.
Okay, got your point. Thank you.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to Mr. Jalan for his closing comments.
Thank you, Lijan. On behalf of Axis Capital, I would like to thank Engineering's management and all the participants for joining the call today. Mr. Jain, I'll hand over to you for any closing remarks after which we can conclude.
No, I mean, I made my opening remarks. I just want to say that looking at the my interaction with OEMs, I'm very optimistic about the future, and including the next financial year. I'm quite optimistic that it will be a good year, because 1920 was a bad year, and the COVID first 3 months were very bad, and so I personally, looking at everything, the whole situation, I'm quite optimistic. Looking at my interaction with OEMs, this is one thing I want to leave with everybody.
Sure, thanks.
Thank you. Ladies and gentlemen, on behalf of Axis Capital, that concludes this conference call. Thank you for joining us, and you may now disconnect your line. Thank you.
Thank you.
Thank you. Bye.